Joe's up for the main talk here. Joe, come on up.
So first wanted to thank, the lunch, so sponsoring the lunch, but I Jalisco, which is out near Sac State, Natoma's resident, has a little family restaurant, always hooks us up, takes good care of us. And then we also have some cookies back there. Adrian Rosa, she's in the back corner there, starting her cookie business, so she brought some cookies for everybody. All right, so great news today is you get to hear about my favorite loan product, right? Outside of the VA loan, DSCR loan, over the past few years has become very popular. It's a great loan product for investors, for new investors, for real estate agents, self-employed borrowers, so we're going to go through all those details. But the reason I thought it was important to talk about this is because this product is much simpler than our regular standard Fannie Mae, Freddie Mac conventional, or conforming conventional investment products. So let me scroll. All right, perfect. Just my information, Golden Bay Mortgage Group, Joe the Mortgage Giant. Have an office right here. If you ever need me, I'm always available. So what is a DSCR loan? Right. So basically stands for debt service coverage ratio. Simple terms is does the rental income cover the mortgage? Right. That's really what they're looking for. So does the product cash flow? This is a business purpose loan. Which is important because that means that we're not held to TRID. It means that the banks aren't looking at things like a borrower's personal income. We don't need tax returns, right? All we're going to care about is a borrower worthy credit score, right? That's generally what we're looking for, a minimum of a 620 credit score, and then is the property expected to cash flow. So, in terms of deals, right, it's very simple to approve a borrower, right? We find out their credit score, we find out what properties or what kind of properties they're interested in, right? Are you looking at single family? Are you looking at multi-unit properties? And we're able to take that and kind of plug it in and give them a general range, saying basically, based on the amount of assets you have, you could qualify for this type of property. And then we're going to look and investigate those properties one-on-one basis to make sure that they're going to work. The fantastic thing about these products is that investors love them because they're not penalized for the number of properties they have, right? So DSCR loans, if somebody has 30 rentals or 30 properties that are mortgaged, right? Easy enough to do. Whereas conventional loans are going to not want you to have more than 10 finance properties. Other things about this, it's a great way to connect to your clients. Right? Connect with those investor clients, reach out. You don't need to know much information about the client, right? You don't have to go into what kind of income you have, right? What other properties you have. We really don't care. So that makes your conversation nice and easy, saying, hey, look, you're interested in investing. I have a product that'll work for just about anybody.
Was there a minimum down payment, like 20%, 10%?
Yep. So I'll go into that, but the minimum down payment on DSCR loans is going to be 15%, right? 20%, 25% give them optimal terms. So that's the most important thing is kind of think about it, right? A little bit more investment means you're going to get a better interest rate, better overall loan, but 15% is the point of entry, which is great. All right, so perfect candidates. In beginning and experienced investors who have short-term rentals, right? So short-term rentals have given us some challenges in the past with, kind of doing investments because, how do you, keep track of that income? Is it going to be stable and consistent? But DSCRs have some great formulas to kind of keep track of that. Self-employed borrowers are one of probably our biggest, the clients that like this the most. Because one of the purposes of being self-employed, right, is to pay less taxes. But many times that bites us when we're trying to get financing because all of a sudden you don't show much income and then you're stuck held to a bank statement loan. But this would kind of bypass a lot of that. Foreign nationals, so many people who don't have the right to work here, right? This is the product that we most often will put them into. Let's see what else here. 620 credit score, 1 to 4 units. One thing to be said about that is 5 units plus, so commercial loans. DSCR financing is one of the most common ways to finance properties, right? So apartment complexes, commercial spaces, DSCR, the overall structure is very similar. A few additional things they need, but it all runs along the same line.
Can you do over 4?
What's that? So you can do over 4, it just becomes commercial.
Can you do?
Oh yeah, I can. Yep. And normally what it is when you get to the commercial space, we're just trying, the biggest thing is looking at kind of the use, where it's at, is it properly zoned for it? But once we have that, we just got to figure out what the going rents are. That's probably the hardest thing right now, is because, rents have been all over the map, and all of a sudden we've seen kind of that little, those
Okay.
What's that? Let's see if somebody, okay. And then these are available for purchase, for rate and term and cash out refinances. So many times we see investors that'll buy a property, they'll get a hard money loan, they'll pay for it, right? They'll do a rehab on it, and then they want to sit there and pull cash out of after repair value. So that's something that's done quite frequently. Most of the time, there are occasions where they'll go to 75% loan to value on these cash outs, but most of them they like to stick around 70%.
I was the one I was good reading there.
But they forgot to mute themselves.
John, question.
Mhm.
Typically, is the interest rate higher on this compared to like conventional?
So interest rates
No more.
are slightly higher, but not really. So the biggest difference on these loans is that they generally start off with a 3-year prepayment penalty, right? But you can get a 2-year, 1 year, you can buy out the prepayment penalty, right? But many times on the 3-year prepayment penalty, they're prorated penalties, right? So if a borrower makes it through 2 years, then we're only basically covering the interest difference for that last year that the investor was going to miss out on. So it's normally pretty mild of a hit for them. But most investors aren't necessarily refinancing for rate really quickly, right? They're normally getting into these, sitting, cash flowing on them, and then doing their next property. So we can strategize that pretty well.
Joe,
Yes.
what's kind of the ongoing interest rate on those cash
Yeah.
refi?
So I just had one close that's about 2 weeks ago at 6.875, but it was at this one was at, and I'll go into it in a minute, but it was a 1.25 ratio, basically meaning they were actually cash flowing on the property. They had great credit score, and then they took the 3-year prepayment penalty.
And they wanted tenant in there before, right?
What's that?
It's gotta be occupied?
It does not have to be occupied. Like on a purchase, you can buy it and we get a rent schedule that'll verify the going rents, and then they'll go off of that. Yep. All right. Let's see what else we got here. ADUs. So multi-units, ADUs, they'll actually use rental income from those properties. So whether that's a 1007, if they're already leased, they'll take the lease, they'll take a 1007, and they'll use the lowest of the two, right? That comes into play when you have a property maybe that's being rented for a period of time and rents are under market. But there is some room for having conversations with the appraiser. Natalie Dennis, who spoke at the last meeting for appraisals, she works directly with the appraisers, right, through the AMCs. And so we think that the rates on the rent should be higher than what, let's say, the 1007 came back. Does everyone know what a 1007 is?
No.
Sorry. It's a rent schedule that we order with an appraisal. It's the form that breaks down what the going rents are. An appraiser basically goes around and finds these values and then assigns a value to it. And then we can go through and say, hey, well, we don't agree with your rents because this property manager said the rents are higher here. Or because I have this lease that says it's higher. All right, and then we can get them to hopefully modify that. And that's actually saved a few deals because having those relationships with the people that work for these appraisal companies. Right? So the goal is just to know what the really rents are, right? I always try to estimate on the conservative side, because then we're pleasantly surprised when we get higher rents, and then your rate gets better. But if I go in there saying, hey, I think the rents will cover the mortgage, but I don't know that we're going to necessarily cash flow much, then we're going with a pretty safe number. And then if we come back at, let's say, 1.25% on the schedule. So for example, let me actually go, I think the next slide shows this. Here's an example right here. So gross monthly rents, $3,000, right? We'd say, hey, the mortgage payment on this is $2,400, right? We'd be at what they call a 1.25% ratio, right? So we are cash flowing by 0.25. That number is very important because that becomes the position in which you are considered like, it's kind of what the banks want, right? They want to know that you're making money on the property, not losing money. But you'll see over on the right that they will go to 1.0 and they'll actually go below. We can actually go to 0.75. So you can actually be losing a few $100s a month and still be able to do these DSCR loans with just a minor rate adjustment. So that's good, because if you do have the property where maybe you have under market rents right now, but you know you're going to raise them in the future, maybe we do a DSCR loan, take the rate that we have, maybe a shorter prepayment penalty, right? You increase the rents, and then in the future we can do a simple refinance and get you even better terms as the market improves. So kind of strategize on that. Most of the time interest rates aren't as important when it comes to investment, right? Because you're writing a lot of the stuff off, right? So when you really look at the overall scope of things, it's many times trying, how do I keep as much money in my pocket as possible? Do I put that 15% or that 20% down instead of 25 or 30%, right? Which might be asked on a regular investment. Any questions on any of that stuff?
What's the purchase price on that PITI there?
2,400 is somewhere in the neighborhood, probably 350,000, 350. It really depends, because if we're quoting most of Sacramento or if we're quoting Natomas, very different, right? That's about a $50,000 difference for the same payment. Natomas does not necessarily make the best DSCR spots, especially in North Natomas, because properties that have flood insurance, have fire insurance, have high property taxes, oftentimes make rental incomes, a little bit more challenging. But again, it's case by case. We can always just see where we're at with the properties. And these are very simple to look up, because when you give me the property and the sales price, right, I can go on and look at, and I mean, now it's nice because ChatGPT and Claude, they'll do a lot of that work for us and go around and say, hey, here are what the going rents are, high, middle, low, right? Super simple, because they're pulling all these data points, and that just gives us a good idea. And if we always just go on the lower side, then we rarely come into any kind of issue. All right. So this just breaks down, this slide is really about the 3 tiers. When we go and price out a DSCR loan with lenders, right, they will normally have like kind of what they call like a max program, which is like their top tier, and then there will be the regular program, and then there will just be kind of the all-inclusive program that will allow for pretty much anything, right? The important thing here is when we go with these higher programs is they oftentimes will have a few additional overlays or conditions, right? They're going to, they like, for example, the higher one, right, they want to have better cash flow. They might require some additional reserves, right? Whereas if a borrower doesn't have a lot of money, doesn't have a lot of reserves, you might want to go with the other product just because we know that we're going to have less point of entry. Programs are always changing. The good thing is that the non-fuel market, the DSCR market, it doesn't shift and change pricing-wise as drastically as conventional loans, right? So Fannie Mae, Freddie Mac, like FHA, VA, you look at those, the market's always shifting a lot, right? DSCRs will see some shift to it, but not nearly as much, and so it's a lot more forgiving when we quote prices, when we quote interest rates. That doesn't change as drastically.
You have one more question. Let's just say the price points over like a million or 1.5. Is this still a DSCR loan, or is it going to be a different type of loan?
DSCR, each of the lenders will have different thresholds. I mean, I have a couple that'll go to 3 million. The problem with those is cash flowing at the high end, right? But definitely see 1.5 million. We do a lot of Bay Area stuff, right? That's it's pretty common. It's nice too because you have borrowers that have heavy cash, right? So it's a great way to invest and have more write-offs and use their cash up, right? And keep it working for them. And all these properties, like they buy in at the lower down payment, and all of a sudden they sit there and take the little ride with the appreciation part, and that's kind of a great conversation for them. The other part of it is these things. I mean, if I can get the appraisal back right away, 7-8 days is realistic with closings. So we have borrowers that all the time will come and they'll have a property for a few years, right? And then they'll say, hey, I want to buy another property. Boom, come in and cash out and buy the next property. So big restrictions, DSCRs. So they're investment property only. So no owner occupied, no second home. So no occupancy by family members, right? Again, how they find out it's a family member, It's always a question, right? Normally it's just on the way the name shows up, but normally there's not much else in that they can see. The reason they say this is because many of I do have some that will allow for first-time home buyers. Many of them don't like first-time home buyers. Not for any other reason than occupancy fraud is a big deal. And many times if you don't have a primary residence, their first thought is, hey, well, maybe you can't qualify the regular way, you're trying to get into this by doing it this route. And that's why many of them say, hey, we don't really want to do it for a first-time home buyer, but there are plenty of banks out there that'll do it. Yeah, no employment or income verification. This is, I mean, there have been times when we were doing investment product or investment loans, and we ended up changing to a DSCR because partway through we realized there was not something right on the tax returns, or the self-employed borrower made some unwise decisions, right? And DSCRs come in and save the day. We can convert the appraisals, so if we have a regular conventional appraisal already done, we can convert that and easily submit that for a DSCR.
What if you have your family members on a rental lease, so then you have documented rental income? Does that work?
So,
like before you even had the loan, you had them in the property and you have a rental agreement, all that.
I mean, it's really probably not going to come up.
Okay.
What they don't want us to do is go out and throw a tenant in there that's our family member to qualify for stuff. And if you have it documented, I mean, there's very, very rarely going to be an issue. They may take a little extra look at stuff.
Okay.
Right, but if you're documented and we have a trail and stuff, I mean, there's not going to be much else that they'll say.
Okay.
Right? They just want to make sure people are being honest. When products or loans are a little bit lax on the requirements to get it, they check a little extra just to make sure that people are on the up and up, right? They want to do these loans. They just want to make sure that people aren't trying to cheat the system.
Makes sense.
All right, confirm business purpose in terms of what we look for. Originally, I mean, the conversation is what's your intent for the property, right? And people are like, oh, I'm planning to rent it. And that's really all we need. If a bank has questions, right? So you're buying a house in the same area that you work and you don't own a home, right? They may require certain letters, things like that we would write just to, cover their needs for the investors. Property type, acreage, occupancy, again, property types are really flexible with these, so we don't have really anything that stands up. I think, let me rephrase that. The ones that actually give us some challenges are going to be manufactured homes, right? And then mobile homes won't work for it because it's not considered real property, so it doesn't work. But manufactured, I have a few banks that'll do them, and other ones that really don't want to do them. That stuff's changing. The way everyone's looking at manufactured homes, these alternative kind of communities and the way they're building stuff, that I see a nice shift, which means that we should start seeing, again, more ADUs on properties, right? Being able to see these off-site, basically, properties are built off-site and then put onto the land because of how cheap it is now to build off-site and bring it in. They're trying to fix the housing crisis, and so unfortunately, our guidelines and our changes with like Fannie Mae and Freddie Mac have been really slow, but we do hear that there's a lot of things being proposed. So I think in the next year or so, we should start seeing a lot more loosening of that.
So if somebody was to have their primary residence and then put an additional dwelling on the property, would that fall under this? If it was set to be a potential rental income?
If they are living in the first property,
Yeah.
the only way we could do that is if that was a separate APN for the ADU. But now cities are starting to allow that, and they're starting to split that off. And if we can start doing some of that, then they will be very flexible with that. Yeah.
Joe, is there down payment assistance at all with this product?
No, so down payment assistance is generally only for primary residents and for first-time home buyers, which the primary residence would basically mean this is not qualified because it's only for investment. Yeah, no, there would not be any down payment assistance. There wouldn't be even any grants for these. These are pretty much saying, hey, you have some money, right? And then we have a very simple product.
Can you clarify what credit events require seasoning?
So things like they had a foreclosure, they had a bankruptcy, they had mortgage lates, right? So some of those things will come up and they're each going to look at them a little different, right? They are going to definitely be a lot more lax than, let's say, conventional loan, which says, hey, you know what, you gotta wait 4 years after bankruptcy, right? These ones will be a lot less like that, but if you have recent mortgage rates, they may have a lot more to ask, right? Because that's what they really care about, right? That you pay your mortgage. Let's see what else we have. Again, this kind of documentation I would get from the borrower is super simple, right? I say, hey, give me a basic application. I don't need your employment. All I need is you to put assets in, and then I just need to kind of know what properties you own. I really don't need much information from those. And all I do is just plug that in. We run credit. You delete any kind of debts that they have, and they only really care about the score. So very easy. If we have, if this is a refinance or purchase and we have lease agreements in place, then I would ask for a copy of the lease agreements. That would allow me to see what the current rents are. If we are buying a home that's vacant, right, I don't need a lease agreement. We'll just get that rentals survey and that'll be good. Reserve documentation, so generally I just need 30 days of whatever asset account we're using for reserve. So savings account, investment account, 401k, so many of these can be used for reserves, as long as the funds are liquid, meaning we can take it, we can, you know, if we need to access that money, we can take it right away. Things that are not allowed for reserves, in most cases, some that we have a few exceptions, but gift funds are generally not allowed for reserves, so you can't like buy an investment property, get a gift from somebody and say, I want to use this for my reserves, right? They normally need to be personal funds. Appraisal, most of the time on these appraisals are the same costs, right, as the standard appraisals. It's just with the rental income statement, which is normally about $150. So an appraisal probably looking at about $800 or something. And then if these are able to be closed in LLCs, right, which is very different than many of our conventional ones, right? You can't really close conventional loans in LLCs too much. But these ones will let you refinance, close on them. It's a very simple process. So this is important we have a lot of borrowers that are very secretive, right? Especially when you start going into the investment side. And if we were to do a conventional loan, most of the banks would say, hey, we want you to pull the property out of the LLC, right, with another title company. Then we will go ahead and refinance it for you, and then you can put it back in the LLC after closing, right? That's what a lot of times they tell us. But these ones will say, hey, you can be in the LLC and we can just close it, right? They're not as concerned about, the reason that other title companies are concerned about that kind of stuff is because they don't know who actually owns the LLC, so they want to make sure that the chain of title is clear. But these ones are like, hey, this is where this is, we're pretty good. So appraisals, right, the biggest one that's different on this than anything I just talked about is going to be for the short-term rentals. So we'll need something like an Airbnb report, we'll need a property management report, something that kind of just outlines the income you've been receiving so we can show the history, right? We just want to show that you've been receiving these type of things and so that's consistent. As long as we can show and give them confidence that these type of rents are likely to continue, they'll be good with it. If you have periods of time where you, let's say, taking it out of operation, right? If it was for like a big remodel, something like that, that's easy to explain, we can show that. But if you take it out and you just, hey, we just weren't renting it for the last 2 months, right, then they might have a problem with that on the short-term rental because, well, this is the history of not receiving it, how do we count it as what you're gonna get? Does that make sense? All right, so again, a little bit more breakdown on long-term and short-term, and I can share this slide deck with you if you have any questions. I have some cheat sheets on this too. But ultimately, long-term rentals are pretty simple. I mean, the biggest things that we want to see, again, on these ones, it's just that you have consistent lease agreements, because if we have to go back in time, we want to be able to present that. Because in these ones, we're not presenting tax returns, so we're not going to be showing your Schedule E, which on most investment products is what we would do to show rental income, right? So we just want to make sure you have some kind of paper trail or something that shows that it's been rented and you can keep track of it. Basically, quick recap is, the reason I like these loans is because it's very accessible to pretty much everybody, right? If you have at least, I would say you have at least 20%, right? 15% down with a little bit of reserves, it's a great entry. And so, for example, a borrower looking to buy his first investment in a $300,000 home, probably needs, let's say, 75,000, right? 70,000 or so in the bank, and you'd probably be able to get into a DSCR loan to kind of start things off. And if you can get a good deal with one of these, so let's say you have a borrower that needs to sell, right? Like I have an example of one that is the borrower's in a reverse mortgage and they just want out of the reverse mortgage, right? So they're leaving about $100,000 on the table, which means you can get in for a great price buying this thing, and then once everything's been closed up, maybe a few months down the road, sit there and do a cash out refinance use off that 100,000 equity. Now you have a little bit more money to put in your next investment. And all you're doing is kind of just come up with that game plan. And these are very simple to kind of do one and do the next, right? And if you have that combination of that and some hard money, it's really a good plan, right? Because now you have capital to actually do some work. You have the money set to be able to acquire the new ones, and then you just kind of rinse and repeat. And yeah, I mean, they're much more of a buy and hold strategy, right? So you're not going to really buy these, fix them up and flip them. They're probably not the best use of these funds, but they are very good if you want to hold some investment properties for a while. Any kind of questions on all that? I know it's a lot. Yes?
Do you have any written information on it?
I have some stuff, and I can give the slide decks and yeah, whatever you need.
So a non-US citizen can still.
Yeah, foreign nationals, yeah, yep. That's actually, as long as they're not, again, as long as they're not gonna live in it, it's great, because we can source foreign assets, right? The biggest thing with foreign nationals and foreign assets is we have to be able to put the assets, we have to be able to convert it into English and into US dollar, right?
Do they have to be here for like 2 years?
They don't have to be here. They can buy when they're, like, for example, I have buyers all the time from China that come here to buy, or that'll just buy the property here. They don't have to live here. Yep.
So this program applies in all the states or just California?
It applies in all the states, and the good thing is there's 35 states I don't even have to be licensed in, because I have my MLS, but I don't have to be licensed in, so I can do many other states that maybe I can't do family or Freddie loans, right? So that's, that's a good thing. So I would just check with me if you have somebody that wants to buy somewhere. Like I had, somebody that wanted to buy in, what was it, in like South Dakota, of all places. But, it wasn't required to have a license. I mean, there's the few that do need to have a license. For example, like Nevada is a very strict state. Arizona, Florida, they require us to have a little bit more licensing. But like Texas, Tennessee, very simple states to do it in.
So your rates compared to conventional?
These actually, I would say right now, these would pair up and probably be a little bit better than conventional investments. If you do a 20% down 3-year prepayment penalty, I'd probably beat the conventional rates right now.
Wow.
Because conventional it's been volatile. It's like every time we turn around, like something with gas prices, something, all of a sudden, rates are gonna go up again, and we're like, we get a break. But yeah.
So what's the usual term?
It's 30-year loan. Generally, you can do short terms if you want, but normally it's the 30-year. Like I said, I did one recently at 6.875. If you wanted to buy out, the difference would be, like, say you do a 3-year prepayment penalty with great credit, 6.875. You want to buy out that prepayment penalty, we might be at a 7.375, 7.5%, right? And the main reason there is that these investors, hey, we have a specific amount of interest we're expecting to make, right? If you're going to say you're going to be with us for 3 years, we'll give you the better terms because we're not going to make more interest over time. But if you're going to buy it out, then we want to make more of it up front. That's really what that's about. Any other questions?
All right, guys, give Joe a big round of applause.